So let's start looking at the debt schedule. And if you, let me pull up the right model here, not this model. If you look at yesterday's model, we have everything done except for the debt schedule. And as we just mentioned, the purpose of the debt schedule is, one, to track the cash available that we may want to use to pay down debts if we choose to model out our business that way. We'll talk about how to do that. So it tracks your cash available, it tracks the debts outstanding, it tracks interest on those debts, potential payments on those debts, and interest income. So a debt schedule usually has three major sections. One, a calculation of cash available that's free to use to pay down the debt. Two, as I mentioned earlier, an ongoing balance of each debt that we have outstanding and the calculation of interest on those debts. So this is where we can start to manage the debts if we choose to. Raise debts, pay down debts. And so we want to make sure that we have a section of debt for each piece of debt represented on the balance sheet. So that's part two, right? Tracking debts and interest. And then three, totaling, here we go, totaling any debt paydowns or debt raises, totaling the interest, and calculating cash at the end of the year. That cash at the end of the year will be used to calculate interest income. Those are the three sections of a debt schedule. So the first thing you want to do is just make sure you have enough of these debt sections that match the types of debts that the balance sheet has outstanding. So if you go to the balance sheet, we have short-term debt, long-term debt due within a year, capital leases due within a year, long-term debt, and long-term capital leases. We have 5 pieces of debt. I recommend keeping them separate, not combining the short-term and the long-term portions of the same pieces of debt. I just keep it separate. To me, it's easier. You can combine if you want. I just think it flows easier this way. 5 pieces. So we should have 5 types of debts that match each of those pieces, and it's already been set up to do that. Short-term borrowings, long-term debt due within a year, capital leases, long-term debt under capital leases. So we've listed those 5 pieces. The next thing you want to do is to make sure you've pulled in the last reported balances of cash and of each piece of debt into the debt schedule. That's the first kind of technical, mechanical thing you'd want to do. So for each piece of debt, we're going to start with pulling in the last reported balance. So short-term debt borrowings end of the year in 2012 will come from the balance sheet. We're going to link this in from the balance sheet. 2012. Long-term debt, short-term borrowings. It's the 4047. Long-term debt due within a year. Same idea. We're going to pull in long-term debt due within a year from the balance sheet. Obligations under capital leases due within a year from the balance sheet. Long-term debt due within a year. And long-term obligations under capital leases, end of year. So make sure you've pulled all of that in. And also make sure you've pulled in the cash at the end of the year from the cash balance. That's the first thing you want to do. All these ending balances will be utilized to create our starting balances the next year. So while you're pulling that in, I'm just going to save this under a new file. Okay? And the first thing I recommend doing, yes, Cameron, sorry.
Isn't it 4,000? Oh, 4,000.
Which one? Did I pull in the wrong? I could have. F.
Oh, no.
We're okay? F. F, F, F.
Yeah.
So the next thing I recommend doing, if you didn't do the whole thing, that's right. Let's just focus on the short. The next thing I recommend doing is build out the ongoing debt balances. Build it all out. So short-term debt at the beginning of the year will equal the short-term debt at the end of the year from the year before. Right? We assume that the debt reported on December 31st is not going to change overnight till January 1st of the next year. So we're going to create an ongoing balance. And you'll see we have two lines underneath that beginning of debt for issuances and retirements. We'll talk about why they are separated, but just know that whether it's mandatory or non-mandatory, an issuance is raising debt and a retirement is paying down debt. That's why retirement is in parentheses. So if we want to raise debt, we'll have a positive number. If we want to pay down debt, we'll have a negative number. So just put in zeros for now. We will use this schedule and manipulate it once the structure is done. And so the short-term borrowings at the end of the year is just going to be a sum of everything above. If we're raising debt, it's going to add in anything that's raised. If you're going to pay down debt, it's going to add in the negative, right? So just kind of start thinking about that structure. So you're adding everything from above. And we then want to calculate interest off of the debt. For now, we got to dig into the Walmart report. We got to figure out what the interest rate is. For now, let's just get the structure in there. So let's just keep interest rate now at, I don't know, 5%. We're going to go back and change it. And to calculate interest expense, you want to take the average of the ending balances between this year and last year times the rate. It's important to take the average because you don't know when a particular paydown or issuance has happened. So in other words, when you do that, you should get 202.4. In other words, if I want to assume I'm going to pay down all my debt, I'll have a retirement of negative 4047. Right? If I didn't take the average, right, and if I did 5% times short-term borrowings at the end of the year, my interest expense would be 0. That may or may not be true depending on when I pay down the debt. If I pay down this debt on January 2nd of this year, then yeah, maybe my interest is 0. But if I didn't pay down this debt until the very last day of the year, maybe I would have had 364 days of interest expense. Maybe it shouldn't have been 0. I don't know when I paid down that debt. So because you're never going to know, we're going to just do an average. If you know when it was and you want to make your own formula and then fine, you can do that. Or if you're going to get into detail about paying down debts and tracking on a monthly basis, then you should be building a monthly model. So typically we just average it. So I'm going to zero out this pay down and I'm going to copy everything to the right. Any questions on that? Okay? We do the same thing for every piece of debt. You can actually just cut this and copy a debt. A lot of people say, oh, you did make 5 pieces of debt. That's annoying. You can just cut this whole thing. The formula is the same, and copy it down, down, down 5 times and just change the names. But just so we get some practice, long-term debt at the beginning of the year equals long-term debt at the end of the year from the year before. Issuances, retirements, 0. Sum everything up. Let's just keep the interest at 5 for now and calculate the average. Copy to the right. Yes?
What's the difference between this and like a minimum function?
We'll do the minimum function. The minimum function helps us better track debt paydowns based on cash available. We didn't do cash available yet. We'll get to that today or Monday. And we'll talk about how that works. But I'm sorry, the difference between the minimum function and what? I kind of cut you off.
Just like hard coding zeros and then on
Yeah,
that variation.
We'll do that. Yeah. It's for the revolver. So you do this 5 times. Okay. I do want to start digging into the annual report and look at what these interest expense percentages should be. Let's get into a little bit more accuracy there. If you look at, so while you're kind of working on the mechanics, the annual report, and I do a word search on debt, there's a couple tables that are helpful. The one I find most helpful for interest payments is the one that has interest rates in there, obviously. Which is coming up. Here. No, that's the pay downs. Here. This is a good table of debts, the expected maturity on the debts, and the rates of each. And so for the short-term debt, this is easy. It lists the short-term debt outstanding of 4047. It lists the average interest rate. Now, the debt does not have a 0.1% interest rate. 0.1% indicates the days of the days that are left on that debt obligation. So they probably did 5% times 350 divided by 365 because there's 4 days of debt left before they pay it down, before they roll it over. Right? But to get to an accurate interest expense, you don't really have to know that. To get to an accurate interest expense, we're going to use 0.1. We want to get to an interest expense that accurately reflects the interest expense that they're going to pay based on what's left over on the debt. Yes? Yeah. Yeah. Yeah, we're going to get a weighted cost of debt based on everything. Yep. This is the cost of them keeping that debt going. Yes, you can. On the DCF cost of debt, and we'll get to this next week, on the DCF cost of debt should be as current as possible. Not based on all of their historical debts, but the market value of the debts, which you would get from either Morningstar, you can go to morningstar.com, or if you can't, then look at their biggest, most recent debt raised. What's the interest rate on that debt? That's a good way to get their cost of debt. So you can't do 0.1% would be way too low. So I would take their whole 44 billion and multiply it by, I think it's 5.26 during this time. Where did I get 5.26? I went to Morningstar. We're going to do that. We're going to do that together. But it should reflect the most current value of debt. Some of this stuff was raised 5 or 6 years ago and is now outdated. Yes, George.
So the most recent would be the gift maturity.
Yeah, that's right.
But I mean, so I'm a little struggling with this because if the market decides that, hey, I'm gonna pay up for that debt because treasuries are because the Fed is buying bonds,
Mm-hmm.
lowering down yields, that's not gonna change the amount that the company is paying, correct?
Correct.
And you have to be still use that as a test of debt.
Yes, because this is the cost of debt is supposed to is we want a market rate. We want to know what is our return to debt lenders out in the market. That's going to give us a market valuation of the company, right? The purpose of cost of debt for the DCF, based on that question, we won't do that for the debt schedule. So to answer your question, for the cost of debt for the DCF, yes, because we want a market valuation. So good clarification. Okay, so let's use point 1. It's 4047. This matches exactly the 4047 that they've listed here. So I'm going to switch this to 0.1%. It's very small. But if we had stuck with 5%, we'd get a number of interest that's much higher than it was last year and inaccurate, according to what they've been paying. Now, long-term debt due within 1 year is a little bit trickier. So here's a long-term debt due within 1 year. 1475. They broke it up into two pieces. 1475 and 500. So 1475 plus 500 equals 1975, which is what we've reported here. If you wanted to be real fancy and broke this up into two pieces, fixed and variable, to match that, you can. I'm not going to do that because it's the same thing as just taking a weighted average. So I'm going to take a weighted average of this information. I'm going to take 1475 times 4.8% plus 500 times 5.2%. That will give me a weighted interest that they've paid, and I'm going to back into my own rate. Okay? So if they paid 4.8% on 1475 and 5.2% on 500, I want to know exactly the interest that they're going to pay in 2013 based on this 1900. So we have here 1900, 1975, right? Same thing, 1975. So I'm going to overwrite my average formula. That's why it's blue. In G23, I'm going to say I want to know exactly what the dollar amount of interest they've paid based on this chart, which is 1475 times 4.8 plus 500 times 5.2. So it's 1475 times 4.8% plus 500 times 5.2%. That's exactly the interest that they've paid. It's their weighted interest. They paid 96.8. Okay? And I'm going to back into what the implied percentage is. So that's 96.8 divided by 1975, which is 4.9%. That's why the number is almost the same. And I'm going to use that 4.9% going forward. So there's a couple of ways to do that, right? I could have done the weighted average directly on the percentage, and for each amount of debt, I want to show you different ways because you're going to have to go back, and this is where the debt schedules look. If you go back and do your own research and dig a little bit, it might not be as easy as finding that one table. You might have to. There might be different debt notes that you'll have to find, and you have to kind of be creative and guesstimate how to come up with your own percentages. So I'm going to show you a different way for each piece of debt to give you kind of good tools. Yeah, so this is 1475 times 4.8 plus 500 times 5.2%. I used that to back into what the implied rate was, 4.9. And then I don't know if I hard-coded 4.9 or did 2014 equal to 2013. I want to kind of match the numbers in the book. James, can I see this? Either way is feasible. So we linked it. So I did H24 equals to G24. And copy to the right. And so when you do that, you just want to make sure, don't copy this hard-coded formula to the right. This is just the 1 year. Going forward now, we're going to take the average formula so that we can model in pay downs and adjustments and have that flow. Yeah. You guys okay with that? All right. Next, we'll do the obligations of long-term debt due within a year. Sorry, obligation under capital leases. The beginning of the year equals the year before. Mandatory issuances, automatic or 0. Add everything up. And so this one was a little tricky. There was no record of the capital lease obligations and the interests relative to that. I tried to look for public filings, or at least I couldn't find anything. Maybe they have it now, but. So what I had done was, and I recommend this as a last ditch effort, because I've seen analysts just do this automatically and it's incorrect unless you have nowhere else to go to. And it only works because they actually separated, which sort of made it easy, the interest expense specifically attributable to that debt. I took the to the capital leases. I took the interest related to the capital leases of 288. I took the interest of 288 and divided it into the average of the 2011 and 2012 capital lease obligations outstanding. I do not recommend doing that often. Again, well, because first of all, with most companies, you only have one interest expense line item. So you can't take the interest expense of all the debts and then add it to the weighted average balance of all the debts, because usually the percentage of short-term debt versus long-term debt varies quite a bit, right? With capital lease obligations, it kind of works because they've actually separated out the interest expense specifically to the capital leases. So in other words, if they had 5 interest expense line items, one for interest expense based on short-term debt, one for interest expense based on current portion of short-term debt, one for long-term debt, etc., then you can do this dividing process. But don't look at this example and think, okay, well, I can just back into the interest expense by taking the interest rate, by taking the total interest expense and dividing it by the average balances of all the debts. You can't do that usually. It only works here because they've actually isolated the interest expense specifically to that one piece of debt. You can't do it to all the debts as a whole. So I'm going to take the 288 divided by, right, the average of the 2011 and 2012 capital lease obligations, but being careful to add the long-term and short-term, because it's the percentage on all the obligations, right? So that's 336 plus, where is 3150, comma, 326 plus 3009. Just make sure that that formula makes sense to you, right? It's the average balance, right, divided by the interest should give you the rate, right? So in the book, I hard coded that into the interest rate cell. You can link it if you want, right? Equal to cell C whatever divided by, maybe that's recommended. It was just too much to write, too many formulas in the book, and you'd lose the point. So I'm just going to do, just to match what we have in the book, 288 divided by average, 336 plus 3150, comma, 326 plus 3009. 8.4. That's what that does. Not the most recommended approach unless you are out of options. It only works here, again, because they've specifically given you the interest expense related to that piece of debt. So typically, interest expense is just one line item for interest on all the debts. So I see a lot of people just taking that interest expense and dividing it by like long-term debt. That doesn't make sense because that interest expense includes long-term debt interest and short-term debt interest and all the other interests. But in this case, it kind of works because they specifically had broken out, which is unusual, the interest expense specifically related to those capital leases. The other problem with this kind of flaw is it's going to be now, we're going to have to be forced to use that same 8.4% on the short-term portion and the long-term portion, which is inaccurate, right? You should probably use a little bit of a lesser rate to reflect the fact that that short-term debt is going to be wiped out within the year. It's such a small number, though. It's not going to make a difference. Everyone have this? 288 divided by the average of 336 plus 3150 divided by 326 plus 3009 should give you 8.4, and then you can back into the actual interest expense. Okay, so the back end, just same average this year, comma last year, times the rate. It's a small number. And you can copy everything to the right. 27.5. If you have doubts, remember, just like depreciation, we're going to assume the interest expense not to shift too much. If it's shifted dramatically, big drop or big increase, there's either a problem in your model or the company has done some dramatic debt pay down. Walmart's not going to do that, right? Unless they make an announcement. Let me know if you have questions on that. Questions? Okay, let's look at long-term debt. Beginning of the year equals long-term debt from the year before. Mandatory, non-mandatory will keep 0. Alt equals adds everything up. And we have to figure out how to do the interest expense on long-term debt. And so going back to this table, something a little unusual here. but I couldn't figure out why. We have a total balance of debt of 44070, right? There's no 44070 anywhere, right? It's 44092 plus 1770. I don't know why. You might try looking at it different ways, pulling out the short-term portions, and So, right, if you look at this, this is the amount that comes due in 2013. That's the 1975. That matches what we have. Here's a short-term 4047. That matches what we have. This is what's coming due in 2014, 15, 16, 17. Thereafter, giving you a total balance of 4492, 1770. This is separated. If you pull out the 1975, it does not come to 14070. Or at least I didn't get it to. Maybe it does. Not if you take the 4492 minus 1475 and the 1770 minus 500. Anyway, regardless. So because it doesn't match, what I had done was I calculated a weighted average. And I'm going to apply that weighted average to our balance of 44070. So just a different way to calculate the weighted average is I took 44092 times 4.6 plus 1770 times 2, and I divided it. That gives you the interest rate, and I divided it by the combined balance of 44092 plus 1770. Right? So just so you can, right? Just a weighted average. Just a straight up weighted average. I took the 44092 times the interest on that, which is 4.6%, plus 1770 times, what is it, 2.2%? It's 2.0%. Divided by, so that gives you the interest expense, just like up here, divided by 44092 plus 1770, divided by the total. Interest divided by the total. That's the way I did it. That gave me a percentage, and that percentage I can apply to our number, which is a little bit lower than the 44092. So on the interest rate section, I'm going to do equal to just what we have on the board, 44092 times 4.6% plus 1770 times 2%. I should have that whole thing in parentheses. Divided by, in parentheses again, 44092 plus 1770. Take a look at that formula. You guys have that? Okay, no, 1 second. Okay. That should give you 4.5%. So I'm going to use that 4.5% as the percentage that I apply to 44070. So I'm going to take the average of this year, comma last year, times that 4.5%. I'm just going to copy everything to the right. Real simple. Guys got it? Okay, capital leases, same idea. This year's capital lease equals the year before. No mandatory or automatic issuances. Going to add everything up. The interest rate on the capital leases, we done already, right? We did it for the short term. We used the short term and long term capital leases, excuse me, because we had no other choice. It's that 8.4. I'm going to pull that 8.4 down. And calculate the average. This year, comma last year, times that rate. Copy everything to the right. Let's continue here. So once we've laid out the balances of debts, there's a few things we can add up. We can total the interest expense. We can total the issuances and retirements, even though they're zero, just to have things linking. So here's a line item that asks for the total of the issuances and retirements. What's the debt that's been raised and paid down that we're projecting? So let's just total that up. So it's a sum of all the issuances and retirements. There's 2 for each debt, so it's 10 line items, 5 debts. Mandatory and non-mandatory for the short term. Mandatory, non-mandatory for long term, etc. So just get that in. And once you have that, you want to total the interest expense. So it's a sum of all these 5 interest expenses that we've calculated. Short term, long term due within a year, capital lease obligations, long term, and the long term capital lease obligations, and we can copy these to the right. These will be linked into our income statement. We don't have to do that yet. Okay? Now we have cash at the end of the year. We want to predict cash at the end of the year next year. In order to predict cash at the end of the year, we need cash at the beginning of the year. Cash at the beginning of the year is going to be equal to the cash at the end of the year from the year before, just like how we did our debt balances. So cash at the beginning of the year up top is going to link in from the cash at the end of the year at the bottom of 2012. We can copy that to the right. It's going to be 0 going forward until we calculate cash at the end of the year. And we're also going to use cash at the beginning of the year to calculate how much cash we have available to pay down debt, which will be used to determine potential paydowns or necessary issuances. And so there are 3 line items that make that up. One is cash at the beginning of the year. That's our starting point. Then cash flow before debt paydown. So we want to take a measure of cash that's been generated or spent excluding cash from debt paydowns. Because, of course, the purpose of calculating cash here is to determine the debt paydown, so we don't want to double count. What am I talking about? if you go to the cash flow statement here, there's a line at the bottom of the cash flow statement called cash flow before debt paydown. It's a subset of the cash flow statement line items, right? The cash flow statement, change in cash equivalents, includes line items related to debt paydowns. We want to exclude those line items to avoid double counting or a circular reference, right? So we want a measure of cash generated or spent without any impact on cash paydown to determine what our potential for cash paydown can be. And in order to do that, we want to add together all the line items again, excluding those line items related to cash paydown. So you want to take all the cash changes from operating, plus all the cash changes from investing, plus all the financing activity line items, excluding the line items related to debt paydown. Dividends, common stock, non-controlling interest, other, effective exchange rate on cash. So we've effectively just summed up again, totaled up again our cash, excluding the three line items related to debts, right? The short term, the long term, the capital lease obligations. Notice we have 5 debt pieces in the debt schedule, but there's only 3 cash flow line items related to that. We're going to need to fix that soon. Don't take the total cash and subtract. You'll create a circular reference that will potentially bust your model. You know, you get all the value errors. You have circular references. Don't do that. Don't do, even though the math is the same, don't do cash minus debt. You're not excluding it. It's still in the formula. Circular reference, crash. Just add it in as if those line items were not there. Yeah, well, there's other reason why it'll crash too, but we'll talk about how to fix that. Copy that to the right. The number is going to be the same now. It's going to look the same because our debt paydowns are 0. But once we have that number populated, it will change. And that'll link into the debt schedule. So on the debt schedule, we will pull in cash flow statement, cash flow before debt paydown. Copy to the right. Okay. Say again? This one? This just comes from the cash flow statement. Do you want to see the cash flow formula?
No.
Okay. This just comes from the cash flow. Then we have minimum cash cushion. Minimum cash cushion is the cash set aside that the company doesn't want to touch as a safety net. Either it's required by lenders. A lot of lenders say you need to have 1.5 times interest payments as a cash cushion for emergency purposes, or you determine you just don't want to spend it for debt paydowns. It's very hard to determine what their minimum cash balance is. I used in the book 100, and I just took that as an arbitrary number. I do not recommend doing that. I should have changed it. I think I did 100 in the book. Is it 1,000? Okay, that's a little better. Did I, Cameron? Thank you. What I would recommend doing, actually, even stronger than that, first do a word search. Sometimes they'll talk about the cash cushion. Rarely do they. Just look at, the best thing you can do is just look at what their balance of cash, what they've maintained for their balance of cash. And if you go back 10 years, they probably hit a minimum of about 5,000. I should have done 5,000. In other words, they're not going below 5,000. They've done a big $3 billion acquisition. They still never went below 5,000. Just kind of see what they've maintained. You're never going to build a model, project a model, and all of a sudden cut this cash balance in half. You're never going to do that. The company's never going to do that. That's just going to throw off their investors with a not spend.
First, we have a bit for cash flow before debt paydown.
Mm-hmm.
I noticed that you included dividends. So
yes.
My question is that don't bondholders have a priority over cash flows before the equity holders, so wouldn't dividends come after the pay down on debt?
They do, but that's not what this is explaining. The priority in payments is going to be done on the debt schedule itself. This is literally just calculating, all else aside, how much debt is going to be responsible for debt payments. So if you want to prioritize and say, I don't know if I'm going to pay those lenders yet, then you got to make this zero.
I see.
Sorry, you got to make that zero. But you're not going to do that. So although what you're saying is right in terms of the priority of payments, in reality, that's not going to happen here. We'll get to priority of payments where we actually model out the payments. Excluding it from here, including it from here, is not determining priority. Yeah, there's another way we're going to determine that. Yes, sir.
I actually struggle with that same question.
Yeah.
I think also, like, even though technically speaking, lenders have the right over dividends. In practice, if you change your dividend policy, it's not a realistic policy for many companies.
Yeah, that's right.
So even though technically speaking, they don't have to pay, they have to pay lenders first. They really can't. They just have to pay it.
Yeah, that's a much better way to explain what I just did. Yeah, right. Yeah, that's right. That's exactly right. Yeah, better put. So good. So yeah, you can't just cut your dividend. What's the impact to the investors on doing that? And your order of preference only comes into play in bankruptcy situations, in which, okay, fine, you're not going to pay you're not going to pay your dividend holders anyway because your stock's going down the tubes anyway. Different scenario. Okay. So let's keep minimum cash cushion at $1 billion for now. And so the cash available to pay down debt is a sum of everything. It's the cash at the beginning of the year, right? What we started with, the balance that we started with, plus all the cash generated this year, excluding the debts. That's the cash flow before debt pay down, minus the cushion. And then you copy everything to the right.
So this part with the formula for cash at the beginning of the year down on
Oh, didn't do it yet. But the cash at the beginning of the year for this year is equal to the cash at the end of the year from the year before. The cash at the end of the year from 2012 came from the balance sheet. I don't know. Was that your question? Yeah. You're welcome.
Oh, where do you get the minimum cash cushion?
That is tricky. That is something, we talked a little bit about that. We kind of looked back. We talked about kind of looking back a few years. Maybe you missed it. It's not a number. You got to estimate it. I used 1,000 in the book. I wouldn't recommend using 1,000. I probably should have raised it a little bit. Although you'll see when we see the mechanics of it, we're never going to hit that minimum cash cushion anyway. It is a number that's determined by your lenders. That's determined by equity investors as to what needs to be maintained in your cash account no matter what. You can't do an acquisition that's going to dip your cash down under this number, right? That's what it is. How we determined it is you should typically kind of eyeball over the past 10 years, what they've maintained as a minimum. They'll never dip under that. They'll never. And that cash is growing. So I probably should have put like $5 billion, maybe even $6 billion for that. It's quite arbitrary. My point is, they're never going to relinquish all this cash. They're never going to cut this cash balance in half unless they've actually stated that they're going to draw on that cash, right? So if you're going to do any kind of major acquisitions, things like that, you're going to have to find other ways to support it. That cash needs to stay there. We'll deal with that when we start to look at the pay downs and when we start to manipulate the model. It's a tricky one. And once it's all done and we start to look at the pay downs and stuff, we'll analyze it further. Okay. How about cash at the end of the year? How do we calculate cash at the end of the year? What do you think? Start with cash at the beginning of the year. Absolutely. You start with the cash at the beginning of the year. And what's changed from cash at the beginning of the year to cash at the end of the year? What else do we include in that? There's cash generated this year, right? There's cash at the beginning of the year. There's cash generated this year, all the cash that we generated. If I want to calculate cash at the end of the year from this statement alone, from what's above in this statement, I'd start with cash at the beginning of the year, right? That's all the cash that's been sitting on the balance sheet, plus all the cash generated this year. But this isn't a complete picture of cash. Why? What does this exclude? What are we missing? All the debt paid down. This is the cash before debt paid down. So in order to get a complete picture of cash at the end of the year, we want to start with the cash at the beginning of the year, plus the cash before debt pay down, plus all the cash from the debt pay down, which is determined by the total issuances and retirements. So those three line items make up cash at the end of the year. Start to become familiar with that. It is, again, cash at the beginning of the year, plus cash flow before debt pay down, plus total issuances and retirements. This is a picture of cash at the end of the year, and we have this matching formula, another matching formula that's an error proof to make sure that the cash at the end of the year that we've modeled from the debt schedule matches, not links to, but matches the cash that's determined on the balance sheet. It's important. It's often that that's off, and if that's off, there's a problem with your issuances, there's a problem with your interest expense, there's a few problems that could happen, and we'll look at that. So this match is helpful. We're calculating cash two different ways. On the balance sheet, it's cash from the year before plus cash from the cash flow statement. On the debt schedule, it's from above. It's from cash from the year before plus cash flow before debt pay down plus issue. So start to become familiar with that. I think I've also, does everyone have this? Does everybody have 27535.1 at cash at the end of the year? You should have that. I've also, I think we didn't finish the working capital. We didn't do this last check. Let's just do this real quick. I mean, we finished it, but there's another important check. This check makes sure they're subtracting working capital the right way. In the cash flow statement, you subtract 2012 from 2013 for the assets, and then vice versa for the liabilities, and that is often forgotten about. So this check makes sure that you're doing it the right way. Just subtract working capital, 2013 minus 2012, and if it's Y, then you're subtracting it the right way. Why does this work? This works because we're calculating changes in working capital two different ways. On the working capital schedule, we're taking the working capital, the total working capital. Total working capital is assets minus liabilities for 1 year. And we're taking assets minus liabilities for the second year, and we're subtracting it. We're subtracting the total. Versus on the cash flow statement, we're subtracting each individual line item and adding up the differences. So we're getting total changes in working capital two different ways. Doing it two different ways proves that we're subtracting it the right way. The other way to do it, the other way that we're doing it is right here on the cash flow statement. So it's making sure that this number, 865.5, which is a sum of the changes, versus on the working capital schedule, which is a change of the totals, matches. If it doesn't match, then you've subtracted one of these things the right way. So another helpful check to make sure that you're going through the modeling process properly. These checks are common. Okay. Now we can link, whoops, went too far. Now we can link on the debt schedule the interest expense into the model, into the income statement. So notice the one exception is we're not going to link total interest expense in because they've broken up interest expense into two pieces. So we're going to separate it also. So I'm going to link in the interest expense on the debts and the interest expense on the capital leases. So the interest expense on the debts is going to link in from the sum of the interest on the short-term revolver plus interest on long-term debt due within a year plus interest on long-term debt. We can link it in from the three pieces of interest expense. Right? Notice this falls in line, our 2083. Even though the varied ways that we've calculated the percentages, this makes sense. If this were to be cut in half or jump dramatically, yet your debt balances didn't, there's something wrong with your interest expense, your interest rates. Good check. Interest expense on the capital leases. I'm going to link in from debt schedule, the short-term capital leases, plus the long-term capital leases. Again, makes sense. A little low. This will change once you start having things flow through. We can copy this to the right. Okay, now one thing to notice is things start to get confusing when you start linking the debt schedule in, which is why I recommend doing the debt schedule as the very, very last thing you do, because if you're doing a debt schedule and your model isn't balancing, this adds a whole different degree of complexity. I have 6042.2 in cash available that I can use to pay down the debt. So I want to look at this and I want to say, all right, well, can we pay down debt? Things like that. 6042.2. Right? Before I added the interest, I had 76919. Why did that change? Why did adding the interest expense make my cash available to pay down debt drop? Say again?
It's a mandatory expense,
Which means what?
which means you have to pay it.
You have to pay it. And how does it flow through mechanically, Daniel?
Net income.
Net income? What else? Walk me through that. You're right, but net income and then what?
What do you mean? Decreases cash.
What about net income? How does it decrease cash? Right, so the interest expense, but walk me through it, right? Interest expense reduces net income by 1 minus tax rate. Net income goes to the top of the cash flow statement, reduces net income on the cash flow statement. That lowers cash available to pay down debt, which lowers the cash available to pay down debt. This is the beginning of intentional circular reference that we'll link through the model. That's going to be important for such analyses like how much debt can a company possibly raise and still have enough cash flow to meet its interest payments. Where is that analysis necessary for? What analysis? LBO. Did someone say LBO? Yeah, LBO. That's the key to an LBO analysis. That's where Excel had allowed the ease of LBO analyses to be created, which we'll start talking about Monday. So start to think about that circular reference. So we're almost done with the modeling. Most important thing is that you get that concept of how that circular reference works. We didn't complete it, but at least how interest expense reduces this. We'll talk about it. So we're almost done with chapter 6 of the book. Next week, Monday, we'll complete the model. We'll step back and think about what are the implications of the model. We'll look about how do you raise debt on the model, how do you raise equity on the model. Tuesday, Wednesday, Thursday, we'll get into valuation, DCF, comps, WAC, P-PAIDs. So we're moving on. I will email this with a link to this class. All right, I'll see you guys Monday.